Covered calls, are they worth it? Today we are going to explore just that and try to uncover the truth about selling covered calls for passive income. Now, after trading options and selling covered calls myself for the past 7 years, I've seen it all: the good, the bad, the profit, the loss. So I thought it was important to make this video breaking down everything that goes into covered calls, and in particular go over the different scenarios that can happen after you sell a covered call. What if the stock keeps going up? What if I want to close out my position? What is that perfect scenario for selling covered calls? Now, going over all of this, you'll have a better understanding of the ins and outs of this option strategy and can better determine if selling covered calls for income makes sense for you. Because at the end of the day, you might look at this and say, yeah, for me, it doesn't make sense to sell covered calls. Or you might be like, I'm set up perfectly for this, and start making income on your stock portfolio. Now, at the end of this video, I'm going to go over my particular strategy that has worked best for me over these years. So if you're ready, then so am I. Let's get into it. Hello, everybody. My name is Alex Pandrea, and welcome back to my channel. So let's break down first what is a covered call and why you would want to use this strategy when trading options. Now, I've done several videos on selling options on my channel, so if you feel like you've missed something out in this video, be sure to check out my other videos to dive deeper into the subject. Okay, so here are the basics for selling a call option. So first, we need to understand that an option is just a contract between two people, the buyer of the option and the seller of the option. When we sell options, we are taking on the obligation to buy or sell stock at a particular price called the strike price sometime in the future, also known as the expiration date. When you sell a call option, you are entering into this contract that will obligate you to sell stock at a strike price on or before the expiration date. Okay, so selling calls, you're obligated to sell stock. So let's break this down. Well, let's say that you own 100 shares of Apple stock and you want to sell a covered call. Let's make pretend Apple is trading at $200 and you sell a covered call with a strike price of $210. This means that you are saying, I am willing to sell my Apple stock at $210 on or before the expiration date if Apple stock reaches $210 or maybe surpasses it. Now, if Apple goes from $200 to, let's say, $205, well, then you won't be obligated to sell your stock because it didn't reach the $210 strike price. If Apple trades above $210, let's say it goes to $215, then you will have to sell your stock at $210 because that's what you agreed on when you sold the call option. Now, you might be thinking right now, okay, Alex, well, why would I want to limit my profit and potentially sell my stock for less than what it's worth? Well, that's a good question, and this is where the premium comes in. The premium is the fee that you collect for selling that option contract. So if you sell a covered call, the buyer of that call, the person on the other side of the trade, will pay you a fee. This is called the premium. Thank you very much. And you, as the option seller, you collect that premium. This is essentially your profit or income for making that trade. Now, the idea here is to sell a covered call, hope that the stock does not reach the strike price, you collect that premium, and you keep your stock. You then win the trade and go on with your life. So the whole idea here of selling covered calls is to sell that option contract, collect that premium, and use that money for income. And you do this over and over again as many times as you can to extract extra cash from just holding stock. Now, that sounds pretty good, right? But the truth is that the trade might not always go your way. So what happens if it doesn't? Well, let's explore this. The first thing that we are going to want to break down is what we need in order to sell a covered call. So before anything, we need to understand the prerequisites to putting on this trade. Many people will try to sell covered calls without understanding these first steps and already be in a disadvantage with making profit. So there are three things that we have to go over to make sure that we are ready to sell a covered call before we do anything, okay? And the first thing is you're going to need 100 shares of the underlying company. Now, why 100 shares? Well, because each option contract controls 100 shares of the company, right? So if you buy an option contract, let's say you are buying one option contract, but that is equivalent to 100 shares, or it controls 100 shares of the company that you're buying the option contract for. If you're selling, again, it's the same thing. You're selling one option contract, and that one option contract controls 100 shares of the company. So you'll see this in the premium if you go into your option chain and you see $2.50 and you try to buy it, and then all of a sudden you owe $250 if you want to buy that. And you're like, wait, I thought it was $2.50. Well, it's because it's times 100 for 100 shares. So that premium gets multiplied by 100. That's sort of what it means when you're controlling 100 shares of the company. But why do we need 100 shares of the company when selling a covered call? Why do we actually have to own the stock? Well, this is called collateral, and this is something that you need to have when selling a covered call. Now, there's different forms of collateral. So if we just take a look at the other side, for example, if you were to sell a put, right? So instead of selling a call, we're selling a put. You're going to need collateral in the form of cash, right? And now when selling covered calls, you're going to need collateral in the form of stock. Now, why is it this difference? Because the definition of selling a put and selling a call is a little different, right? When you're selling a put, you're obligated to buy shares of a company if the stock reaches that strike price. So if I were to be obligated to buy shares, well, what do I need to buy shares? I need cash to buy shares. So you're going to need collateral, something that is locked in by your brokerage account or your trading account that says, I have enough cash to buy that stock if I needed to. Now, on the call side, we are going to need collateral in the form of 100 shares per option contract because, again, the definition is a little different than selling puts. See, when you sell covered calls, you are obligated to sell stock. And if you are obligated to sell stock, well, you're going to need the stock. All right, you're going to need it in the form of collateral. And your brokerage account is going to require that you have enough shares in order to sell this option contract. Because what happens if you don't? Well, I'll just give you a quick example, and it's not pretty. If you don't own 100 shares of the company before selling a covered call, this is called naked selling or naked option selling. And this is not good because you will be then obligated, if the trade doesn't go in your favor, to go out in the open market, buy 100 shares of the company with your own cash to then sell it at the strike price that you agreed on. Now, this obviously is a problem if you sell an option contract on a stock that, let's say, is $200, right? And then you're forced to then buy 100 shares of a $200 stock. Well, do the math. 100 times 200, that's $20,000 that you're going to have to come up with. And if you don't have it, well, then you get margin called. And if you get margin called, well, then that's not good. Now, a lot of trading accounts won't even let you sell options without this collateral. And if they do, if you have a margin account or something like this, I would just be very cautious. My personal opinion, I would never sell a covered call without this collateral because this is how you get wrecked. Step number 2 is you're going to want your stock already in the profit in order to set up a covered call strategy. Now, what does this mean? Well, let's say you buy stock at $50 and now it's sitting at $75 or $80. You made profit already in that. This is a perfect time if you want to then start selling covered calls because you're already in the profit with your stock portfolio. Okay. If, for example, you bought stock at $50 and then it went down to $40 or $35 and you're sitting on a loss, well, then it wouldn't make sense to then start selling covered calls because you might be forced to sell your stock at a lower price than what you originally bought it for to lock in a loss. And I don't think that that makes too much sense, okay? All right, step number 3, before you sell covered calls, you want to make sure that the premium that you collect is worth it in order to take on this obligation and use this option strategy. Now, I put here a premium of 1 to 2%. This means that you're going to want to collect 1 to 2% of that capital that you're putting up and you're sort of locking up in this trade in the form of cash for selling puts, or in this case, the amount of stock that you are putting up. You are using that stock as a reference and you want to, on that stock, make a return of 1 to 2%, and this is on a monthly basis. Now, this is not set in stone, of course, but the idea behind this, and we're going to work through all the details throughout this video, but the basic idea of 1 to 2% is that if you make 1 to 2% per month and stretching that out to a year's time, and then factoring in closing your position early, taking profit early, paying taxes, all that stuff, you will hopefully reach a profit that is still above what you would get if you were just putting your money into the stock market and letting it grow from there, right? The whole idea is to collect premium to be added on top of the profit that we would already make by just putting our money in the market and just letting it sit there, okay? That is the whole point. We want extra cash, we want extra income. Now, of course, there are other factors that would go into this, but for you as an investor to make less of a return than the market, you would have to have a good reason for it, right? And that's what we're going to go into later. But also, the other thing that I want to mention is that you, by taking on this strategy and taking on this risk, you want to at least beat the risk-free return of putting your money into government treasury bonds, right? So we're going to want to aim to do better than that when taking on this obligation that we have when selling covered calls. So a good amount to look at is 1 to 2% premium that we take in relative to the amount of stock that we put up as collateral. Now, this is important because different stocks have different premium amounts that you can collect. Different stocks have different volatility, which affect option prices as well. So once we have all these three steps locked in, we can go ahead and begin our journey into covered calls. Now, the first scenario that I want to take a look at is the perfect trade when selling a covered call. This is what you want to happen when you sell a covered call. Now, there's a lot of things that go into this, so you'll see sort of at the end of everything how it's kind of hard to hit this consistently. And this is what has to happen. So the stock is trading up, 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 up. Oh, it's going a little bit sideways. It's going a little bit up. And you decide you want to sell a covered call when the stock is at $200. Okay. So the stock is at $200 and you decide, I'm going to sell a covered call for a certain period of time out. And you sell that covered call with a strike price of, let's say, $215. All right. $215 here is the strike price of 215. Now, what we want to happen is that stock to go from $200 and trade up, 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 maybe sideways, but eventually you want it to go up. And when selling covered calls, you do not want the stock to hit the strike price before the expiration date. So here's the expiration date, this orange dotted line, all right? So maybe it gets to $210 at the expiration date. Now, it didn't hit $215, so that means that you win the trade. You collect a premium here when you sell that option contract. You get that premium that's in your account right away. Now the trade goes on and it goes up, and now it's at $210. Oh, expiration date comes. Good. You're done. You didn't hit the strike price. You're good to go. You collect that premium, you keep that premium, and then hopefully then it trades up to 215 and the stock keeps going up. Now let's take a look at everything that needs to happen for this perfect scenario to play out. First of all, after you sell that covered call, you want that stock to keep trading up, but not up all the way to your strike price. You still want it to go up because remember, you're holding this stock. And every time that stock goes up, you are making more money. This is obviously a good thing, but you don't want it to reach that strike price. You still want to make money with your stock, but not reach that strike price. So you have to be correct in not only, so there's three things you have to be correct in for this perfect trade to happen. First, you have to be correct in the direction of your stock, but you also have to be correct in how much the stock moves. Okay. So you want to be correct with the direction. You want to be correct in how much it moves, as in not too much. Okay. It's got to move a little bit, but not too much. And you also have to be correct with the timing because you have an expiration date. And you want to make sure that that stock does not reach the strike price by the expiration date. So as you can see, three key factors here that you have to line up sort of perfectly for that perfect trade to happen. Now, if this happens, well, perfect. And there are ways that we're going to go over to have this a more likely scenario for us. But what happens when other scenarios play out? And this is where scenario 2 comes in. And in this scenario, this is funny because I get quite a few questions on this. And at the end of the day, you're going to see that this has nothing to do with your option strategy at all, and you'll see why. So let's say that your stock is going up and up and up and up and up, and it reaches a point where you're like, oh, wow, I think I can sell covered calls here because I think that the stock won't go up so much anymore. It's already gone up a lot. I'm going to sell a covered call here. So let's say the stock is trading at $200 and you sell a covered call with a strike price of $215 right here. And just our luck, as soon as we sell that covered call, the stock just keeps going down and down and down and down and down until it hits $180. Well, This is good news and bad news at the same time because, on the one hand, you sold a covered call with the strike price of $215. Well, the stock did not hit $215. This is good because you get to keep the premium that you collected for selling that call at $200 when the stock was $200. But the stock also did go down to $180. This, of course, is less than what it was just a few weeks ago, let's say, when you sold that covered call. It was at $200 and now it's at $180. So even though you kept the premium for selling this covered call at $215, well, you lost gains on your stock portfolio of $20 per share. Now, let's take a step back and just analyze this for a second. Imagine that you never sold that covered call. You don't even know what options are. You're holding the stock and the stock is at $200. And then it goes down to $180. Well, you still lost $20 per share. Well, this would have happened regardless, again, if you sold a covered call or you did any sort of option strategy on top of it, your $200 stock will still have traded down to $180. So you still lost money on paper of $20 per share. Now, adding the covered call on top of it, you have a few benefits. Now, first of all, by collecting that premium, this actually reduces your loss on the stock. So you might have lost, let's say, as an example, $1,000 on your stock portfolio. Again, these are not actual losses until you sell, right? So, but let's say your stock portfolio value went down by $1,000, but you collected $100 in premium. Well, then you didn't lose $1,000. You actually lost $900 because you're factoring in that premium. So that premium is sort of a way for you to cut your losses if that stock does go down. Now, this is also why it's important for you to have your stock in profit before you sell covered calls. So let's say your stock is sitting at $200, but you actually bought it down here at $100. So you just doubled your money. Well, then it went from $200 to $180. Well, you still made money because if you bought the stock at, let's say, $100, well, $180 is in the profit. So that's okay. And you also collected the premium on top of it. But if you were to, let's say, just buy that stock at $200 and then sell that covered call for $215, sure, you're going to collect the premium. But the loss from $200 of where you bought the stock to $180 is going to feel like more of a loss than that little premium that you collected. So in order for this to not feel like such a loss, you're going to want to make sure that you're already in the profit with your stock portfolio, because if you're in the profit, well, then you're just losing a little bit of that profit if the stock goes down. And again, this is not an actual loss because even though your stock goes down, you are not selling for that loss. You're not locking in that loss. You're collecting a premium, and ultimately that stock will do what it wants to do, regardless if you sold that covered call or not. Okay, hope that all makes sense. Moving on to scenario number 3, let's take a look at what happens if the stock reaches the strike price and exceeds the strike price by the expiration date. Okay, this is the one that we don't like very much because this means that we have to do a few things, and ultimately you're going to not lose money, but you're going to lose potential gains and all of that kind of stuff. So let's take a look at the scenario. Let's say you have a stock, hopefully it's in the profit. You bought it at 100, 150, somewhere below $200. It's now sitting at $200 and you decide you want to sell a covered call and with a strike price of, let's say, $210 in this case, all right? So here's your strike price of $210 and the stock is going to trade up and up and up. Remember, you do not want it to hit $210 before this dotted orange line, which is the expiration date. But what happens? Well, stocks will do what stocks do and it trades up and it hits $210. Not only that, but it keeps going up and up and up. And by the expiration date, it is now sitting at $215. Well, in this case, what happens? Well, then you would be forced to sell your stock at $210. When the expiration date comes, that person on the other side of the trade will say, I think I'm going to exercise my rights to buy stock at $210 because remember, it's at $215. So the person on the other side of the trade is buying it for $210 and could sell it immediately for $215 for instant profit. So in this case, you are then obligated by the terms of your contract to sell at $210. So you are losing out on $5 per share of where the stock is now and where you sold it or where you will be forced to sell it for. So $215 the stock is right now, and you're like, no, I have to sell it at $210. But let's keep a few things in mind. Is this a loss? I ask you, is this a loss? Well, you can look at it one of two ways. Yes, it's a loss on paper of the potential gains of what you could have made with this stock, right? So I bought it at $100, let's say. It's at $200. Whoop-de-doo, you doubled your money. You sold a covered call. It goes then past your strike price. Now it's at $215. Well, now your equity is $215 times how many shares you have, but you're forced to sell at 210. So you lost $5 of extra profit per share. Now, this could seem like a loss, right? Because you would see on your trading account the value of your stock at $215. Now, when you sell it for $210, you're going to see that equity basically in your stock just come down. And that's going to feel like a loss. But again, as long as your stock is in the profit and you sell a covered call, that covered call will always be above what you bought the stock for. So no matter what, even if you're forced to sell the stock at $210, you will still have made profit, just not as much profit as you would have wanted. And again, remember, we're always calculating in the premium that we received. So even though we sold at $210, if we collected a premium of, let's say, $2, then we really actually sold at an even higher price of $210 plus the premium $2, $212 per share. I hope that all makes sense, right? So again, taking a look at this, I like to call this the oops scenario. Yes, we didn't quote unquote win this trade. We didn't have that perfect scenario play out. The stock reached the strike price, it went higher than that. And from here, with this scenario, we have a bunch of decisions that we have to make as investors. And this is what I want to look at next. What happens if this scenario plays out? Oops, what do we do from here on out? So let's take a look at them right here. So we're talking about closing the trade. And first and foremost, instead of closing the trade, you can actually roll your position. This is the first thing that you can look at when you're in the position of the trade going against you. You can roll your position. Now, what is rolling the position? Well, essentially what this means is that you are going to try to save this trade if possible. And this means that you're going to open up a new trade either with an expiration date that's further out to extend the trade or a strike price that is higher, okay, to give that trade more time to do its thing and hopefully not hit the new strike price or by the new expiration date, okay? Now, there's a lot that goes into this of how to actually roll your position, if you're going to do a higher strike price, if you're going to do a longer expiration date. Now, I did a whole other video on the details of that, so I think if you click there, you can watch it next after this. But just know that you can potentially save your trade by rolling your position. Now, in my personal opinion, I've had mixed success with rolling positions. I sort of feel like sometimes it's not worth it. And again, it's on a case-by-case basis. Sometimes it is worth it to roll the position out in order to save the trade. Sometimes it's not, because that extra premium that you're going to collect by putting on a new trade is ultimately not going to be worth it instead of just closing out this position and starting again. Okay. Again, that's just my personal opinion, and that's a case by case basis based off of your scenario that you have set up for this trade. But do go ahead, watch that video on rolling your position. But that is the first thing that you can think of when you're in this position. Say, okay, can I roll this trade? Does it make sense? If the answer is no, then we can keep moving forward to the next option, and that is to use premium to buy back your call. So we know that when we sell a call, to close the position out, you have to buy that call back. We have to do the opposite of what we did in order to open that trade. All right. So, very quick example, if you buy stock to close out that position, you're selling the stock. Easy. When it comes to options, that is easy as well. When you buy an option, to close out the position, you sell that option. Pretty straightforward. But if you sell options, right, you're selling the option to close out the position, you have to buy it back. Now, a lot of the times you don't need to buy it back, because if the stock does not reach the strike price, there's nothing to buy back. That contract is worthless, is worth $0. You get to keep all the premium and go on with your day. But sometimes, and you'll see in these later examples, of you can close out the position early. And to do that, you have to buy back that contract. So if you are in the loss with your covered call position, that is that you owe more money to close out the position than you did taking in that premium, well, then you can use that premium to buy back the contract and sort of cancel it out. Again, if that premium is enough to do so. So let's say you collected $500 of premium, but that stock keeps going up and it reached the strike price, right? At that point, you're going to have to buy it back in order to keep your shares. Again, you don't want to sell your shares, you just want to close out the trade. So you're going to use that premium to buy back the contract. Let's say you have to put up $500 or, $400 or something close to that premium, you use that premium. Now, a lot of the times what's going to happen is that if the stock reaches the strike price before the expiration date, well before it, then you are going to, in order to close that contract out, if you don't want to sell your shares, you just want to close the contract, close the trade, you're going to have to then put up more money than you have in the premium that you collected. So if you collected $500 in premium, then you look at your loss or quote unquote loss on paper of how much it would cost to buy back that contract to close out that trade. Maybe it's going to be $800, right? And you look and you say, well, I only collected $500 in premium. This is where number three on closing the trade comes in. The third option is to use cash to buy back the call. Now, using cash to buy back the call, that is going to be your premium plus extra cash that you didn't collect in your premium. So you're going to have to use your own cash in order to buy back that call and close out this trade. Now, what does this mean? Well, this can potentially mean, or it might feel like a loss on this trade because you're going to need to use your own money to close this trade out. You're going to use money that wasn't part of this deal at all. It's more than the premium, right? Collected $500, it's $1,000, $900. You're like, okay, now I have to come up with another $400 or $500 of my own money. Now, yes, this is a loss in the fact that you have to pay money, okay? But if you take a look at the specific scenario, if the stock reaches the strike price and surpasses it, and you look at your stock equity, how much you have in that stock, the profit that you would have made in that stock would have been more than the loss that you would have to put up of cash to buy that call option back. Let me say that again. The stock itself, as it goes up, you're going to make money on that stock. But as you make more money on the stock, you might have to, if you want to close your position out of selling that covered call, you might have to put up cash to buy that call option back. Well, the cash that you're going to have to put up from your own account is going to be less money than the profit that you made on the stock portfolio. So your stock portfolio is going to continue to go up, and that profit is going to be more than that loss that you're going to incur for buying back the call option. So if the stock shoots up and you have to put up $500 to close this position out, and you look at your stock portfolio, you're going to see things like $2,000 or $3,000 profit in that stock position. So subtracting that out, you're like, well, I still made money on the stock. Obviously, it might seem like a loss to you because you have to put up your own cash, but that's the name of the game. That's the obligation and sort of the risk that you take on. But always keep in mind, you're not actually losing money because even though you put up that money, you made more money in the stock, things should be good, okay? You take a deep breath, everything is okay. And if you do close out the position, then you still keep your stock, and then you could go on and try again with another covered call. All right. Now, the last option that you have is just to sell your stock. Okay. And this is why, again, it's important to have the stock in profit when you do this. If your stock is in the profit, you bought it at 100, it's at 200. And let's go back to this scenario. You bought it at 100, it's at 200. It goes all the way up to 215. You're like, oh no, I have to sell at 210. That's okay sometimes for you. That's okay because you already bought it all the way down here at 100. You made $110 per share of this investment plus the premium that you collected. So you still made money. You might take a look at that and say, you know what? I'll just let my stock go. I'll get called away and I'll move on to the next investment. And a lot of the times you might want to do that on purpose. All right. You might want to do this if you already are thinking of selling your stock. So you made a bunch of money on the stock. You want to take that money, put it into another investment that you think might be better. So you might be okay selling your stock. So you sell covered calls. Oh, it gets called away. Stock reached the strike price. Not a problem. I'm going to just allow my stock to be called away, sell my stock, and go on from there. Now, this brings me to the big question of the day. Is it worth it to sell covered calls? Well, let's take a look at some of the things that you might have to answer for yourself in order to answer this question. So, is it worth it? Well, the first thing that we have to understand is that you are going to be taxed on your stock gain. So, what does this mean? Well, if you are in the scenario where your stock gets called away, because this is always the risk in selling covered calls, you have to sell your stock. you are going to be taxed on your stock gain. Now, do you want this or not? Is this a risk that you are okay taking for the premium that you are collecting? All right, this is something that only you can answer. Now, obviously, this is because you're going to be already in the profit with your stock position. If you're not in the profit, well, then you don't have to worry about your tax being gained. But then on the flip side, you have to worry about selling out of your stock at a loss. All right, so you think twice about selling covered calls at that point. Probably, if you ask me, it's not worth it to sell covered calls if you're not in the profit with your stock. But if you are and you get called away, tax on the stock gain is something that you have to think about. Now, moving on, you are also going to be taxed on the premium that you collect. So, the premium gain that you make, the profit in premium that you collect for selling these covered calls, these will be taxed as well. Now, these will be taxed at a short term capital gains tax. So, you have to take this into account. This is why I said when looking at the premium 1 to 2%, when you factor in things like closing your position early or being taxed on your premium, that will sort of level out. So even if you make 15%, 20% selling covered calls of 1 to 2% per month, you also have to take into account that you are going to be taxed on those gains, which will ultimately bring your net profit down. This brings me to a very important question. Can you beat the market? Can you beat the market? Now, ultimately, us as investors, we want to do as much as possible with what we have in order to at least beat the market or at least beat the no risk return of putting our money into treasuries, right? Now, selling covered calls is a lot of work. You have to understand a lot of things, right, in order to do this successfully. Now, what is the point of doing all of this and learning all of this and putting the time and effort in if you cannot beat the market? So if I could put my money into treasuries and get a 4 or 5% return, or put it into the S&P 500 that has on average return 8 to 10, maybe 12% per year, then what is the point of selling covered calls if we cannot do at least that? The idea is to sell covered calls and have that profit be on top of what our stocks are doing, right? If we're selling covered calls on the S&P 500 and we just have it in an index fund and we sell covered calls on top of it, the idea is to not get called away, have the S&P 500 keep going up, but you're selling covered calls for extra money, extra profit on top of it, extra income. That is the whole point, right? Now, with that being said, I want to give you something to think about. Now, there are ETFs out there that you can invest in, and what they do is they sell covered calls and you collect the premium, you collect the profit of them selling covered calls. Now, in the research that I've done, and I've done quite a bit, usually, and I'm giving sort of an average number, you can look this up yourself, ETFs do about 13%, 15% maybe on selling covered calls. This is the profit that you're going to take in. And you might look at that extra percentage return on top of the market's 10% return and say, oh, it's worth it for me. But keep in mind a few things. You have to pay the taxes on that, obviously, right? So that's going to have your net profit little lower, but also a lot of the times, if you take a look at these ETFs that do covered calls, the equity that you have invested with them is going to decrease over time. So adjusting for the equity decrease or the depreciation of your investment, even though you're collecting the cash as premium, that has to be factored in. So at the end of the day, again, this is based off of my research, covered call ETFs or the people that do this professionally can maybe beat the market by 1%, 2%. Sometimes they don't. Sometimes it's just flat, the exact market returns. That's what the covered call ETFs do. Sometimes it's a little lower. So understanding this, you can take a step back and for you as an investor say, is it worth it or do I just put my money in the S&P 500 and let it compound? And this is where the next and final question comes in. Income versus investment growth. You as an investor have to determine for you, do you want income or do you want the investment that you have to grow and compound over time? Now, these are two different strategies, right, and philosophies in investing. And again, depending on your risk tolerance, how old you are, how much return you are okay with given the risk that you have to take, all of these factors you have to look in. What type of investor am I? Do I want income, right? Do I want investment growth? Sometimes, if you are a young person, you want to invest that money to grow and compound over time, and you're not really looking to extract cash. You don't want that income. Perhaps if you are later on in life and you've already made a chunk of your money and you want income from that, well, then you can invest in things like, dividend stocks or treasuries for that matter and just get a coupon payment every time. Or you can take a look at something like covered calls in order to extract cash from your investments. Now, I hope that all makes sense. I hope you can take a look at the bigger picture here and understand that sometimes it's just not worth it selling covered calls. Sometimes it is. And sometimes you might want to do it once or twice, or you might want to use this as a strategy if you can figure out the best way to do it, if you could figure out the best way to do it. And this is what I want to talk about now. Now, over the last years, I've sold covered calls, I bought calls, I've sold calls, I've done pretty much every strategy that you can imagine. And I've come to realize one thing is that for me, my investment philosophy when it comes to options is that I want to use options alongside the investing that I already do. I do not want to just focus on options as a way of making money. And certainly, if I will use options to make money, I will go for greater returns than what the stock market can offer. For example, things like investing in leaps option contracts, right? That can make you a greater return than obviously just selling covered calls. Now, selling covered calls myself on a consistent basis, and with all the research that I've done, I've put together the strategy that I feel works best. Again, this is my own personal strategy. This is what has worked for me. And I will lay it all out here so that you can take this knowledge and apply it to your investing and see if it makes sense for you. Now, before you look at this graph and get all confused and might want to click away, I urge you to stick around because this is a very important chart for covered calls to understand. Because once you understand this, you could understand probability of success. And once you understand the probability of success, you will end up in this scenario, the perfect trade, rather than this scenario where you have to go through and roll positions and close positions and make less money than you wanted to, all those things. Okay. So we're trying using this, the knowledge that we're going to have with this chart to push our probability of success into a winning trade. Okay. So let's break this down. This is a normal distribution curve. All right. And this will show you the probability of success based off of standard deviations. All right. So stick with me. I'm breaking everything down step by step. Don't worry. It's easier than it looks. All right. So in the middle here, we have the stock price. All right. And the stock price could either move down or it can move up. Now, typically, the stock can move down or up only by a certain amount based off of volatility and history of stock price movements. And we look at something called standard deviations, all right? One standard deviation move lower or higher will get into this range, this red dotted line right here. If we take a look at on the left side, if the stock goes lower, on the right side, if the stock goes higher, these points right here is one standard deviation. And this happens 34% of the time. And this is all about probability. So 34% of the time, it will move within this range. 34% of the time, it will move within this range. If you combined these two together by adding 34% plus 34%, you get 68%. So 68% of the time, the stock will move within one standard deviation. Now, if we go out to the next points, this point here and this point here, these are two standard deviations away. And the two standard deviations have a percentage as well, 13.5 on one side, 13.5 on the other side. So if we add in 13 plus 13.5 plus 13.5, that is 27. 27 plus 34 is 68. 68 plus 27 is 95%. So if you do that math, two standard deviations, that means 95% of the time, the stock will move within two standard deviations. And then you go on so on and so forth to three standard deviations out. And usually that, is very unlikely to happen. So again, 95% of the time it will move within two standard deviation, and 68% of the time it will move within one standard deviation. So 68% of the time it's going to move between these 2 points. Well, how do we determine these 2 points, right? The lower end of the one standard deviation and the higher end of the one standard deviation. Well, for this, we take a look at the probability of that option expiring out of the money. Now, remember, if we buy a call option, we want the option to expire in the money, right? So it has value. But when we are selling options, we want that option to expire worthless, to expire out of the money, as in the stock price does not reach the strike price. Because if that doesn't happen, this contract is worth $0. You don't have to buy anything back. You keep the entire premium, and that is all from that option expiring out of the money. So by looking back at the chart, we can determine that. So let's say that we sell a call option right here at 1 standard deviation. This means that if we mark that spot right here, okay, with the 1 standard deviation, that means that we want the stock to move anywhere from the pencil on to the left of this curve, right? Anything above here, we're going to lose on the trade, right? We're going to be in this position. So anything to the left of this curve. So all we have to do now is take the 1 standard deviation to the right and add up every percentage that goes into it, right? So 34 plus 34 plus 13.5 for 2 standard deviations, moving on to 3 standard deviations, 2.35 plus 0.15%. If we add all this up, you'll notice that it gets to 84%, okay? So all of this right here is 84%, right? This is the magic number that we want to look for. 84% of the stock moving to the right a little bit, 1 standard deviation, and to the left up to however many standard deviations you can get. Because again, that's just going to mean if it keeps going down, your stock is going to go down, but still, you've already in the profit with the trade, you've collected the premium. That is still okay for our scenario here. So all of this is going to be profit. So this means that we want a call option. We want to sell a call option at the 1 standard deviation that will give us 84% chance that that option will expire out of the money. Now, on the other hand, we have on the right hand side of this, the losing side of the trade, we have, if we take 100 minus 84, you're obviously going to get 16. So you have a 16% chance that this will happen, all right? So to put the odds in our favor to win this trade, we have an 84% chance versus a 16% chance. So 84% chance is in our favor, 8.4 times out of 10, you're going to get a winning trade. So how do we determine this on the option chain? Well, this goes into the strategy right here of what we want to do. All right, so the first thing that we want to do is pick an expiration date that is 30 to 45 days out. All right. The reason for this is that if you sell weekly options, which is very enticing to sell weekly options, and you're probably going to collect a little bit more premium than if you were to sell monthly options, right? 30 to 45 days out, just because you can do it 4 times in a month, you will realize, and I know this from personal experience, that the volatility within 1 week is much higher than the volatility within a month. So what that means is that the stock can shoot up, come back down, and those spikes in volatility within that 1 week span can make it so that it surpasses your strike price within 2, 3 days. And you're like, oh, now what do I do? I'm in the oops scenario. I should have went out a little bit more. And you're always going to say that to yourself. I always say that to myself when I was testing out these weekly options. I would do it for a week and it would just be too volatile. I'd have to close out my position early. I'd have to take less premium than I wanted to. And when I was doing monthly contracts, I would collect a good amount of premium, but that option contract would decay with the volatility coming down over the longer period of time, and I would keep ultimately more premium. So again, in my experience, 30 to 45 days out as an expiration date is a good starting point for you to test out selling covered calls. Now, the probability, again, it's all about probability. You want to look for a probability of up to 84%, like we spoke about. Selling at 1 standard deviation out, that means that we have an 84% chance that that option contract will expire out of the money. So if we flip the script on that and we say, okay, well, then we just have to take a look at what is the chance or the probability that that contract will expire in the money. Well, then we just reverse the numbers, right? So we have to take a look at a contract that has a probability of expiring in the money of 0.16. All right, so 0.16, that means that 0.16% of the time that this contract will expire in the money. Again, that is not what we want. All right. So we want to make this number as sort of low as possible while still collecting a good amount of premium. This is why I also sold covered calls with a 0.25% chance. And to get this number, you have to look at the delta, right? Now, the delta tells you a few things. It tells you how much your option contract will move relative to $1 move of the stock price, but it also can tell you the probability of that contract expiring in the money. So stay with me here. If we know by looking at the delta what the probability is of that contract expiring in the money, then ultimately we know what the probability is of that contract expiring out of the money, right? So if it's a 0.25 delta on the call side, then we know that it has a 25% chance of expiring in the money, which then tells us it has a 75% chance of expiring out of the money. And that's what we want. We want it to expire out of the money when selling these covered calls. So this is why we're going to take a look at a probability of 75% to 84%, 84% being that one standard deviation. And after that, if you go higher up, you're going to collect a very small amount of premium that it might not be worth it. Sure, you can sell a covered call with a two standard deviation move outwards, and have a 95% chance that that stock will not reach the strike price. But then again, you're collecting very little premium and it won't be worth it. You're going to be like, oh, just this amount, I might as well not even do it. All right. Sometimes you might say that. So you want to stick to, again, my opinion on this, 84%, and push it back because you will realize that the expected move of a stock, or in terms of volatility, the expected move, the actual move is less than the expected move. Now, this is a very important piece of information that you want to keep up here when looking at probability. The actual move of the stock typically is less than the implied volatility of that move. And even in percentage terms, this is not an exact science. So I found success selling with the probability of out of the money from 75% to 84%. So that's possibly a little bit less than one standard deviation move. This way we collect a little bit more premium. The stock doesn't get to that one standard deviation move. In fact, the actual movement is going to be less than what we can predict using probabilities. And you collect your premium and you do that over and over on a month by month basis, 30 to 45 days out. Now, the last key piece of this strategy of what I would do is I would close my position early from between 50 and 75% of the premium that I collected. Now, what does this mean? So let's say you collected $500 of premium, and maybe that is 2% profit of the collateral that you put up. Well, in my case, a lot of the times I would not have waited until the full 45 days of expiration would occur. I would close it early. If I see a sudden drop in the stock price and a sudden drop in my option contract, and if I see my option contract with a profit of 50 to 75%, I would just close it out. That means I would buy it back and then I would open up a new contract collecting more premium, right? So I do this on a month by month basis. I open 30 to 45 days out. I look for a probability of success to pick my strike price of 75 to 84% chance of expiring out of the money using delta. And some brokerages actually tell you the probability of that contract expiring in the money. But if not, just look at delta, okay? I would collect the premium and then I would close it out 50 to 75% of the profit. So if I collected $1,000 of premium when I'm already in the profit $500, $600, $700, I would then buy back the contract with $300, keep $700, and that would be my profit. Now, as you can see, there is a lot that goes into selling covered calls. Now, you have to make the decision for yourself. Is it worth it to sell these covered calls, or would you rather just stick with investing in good companies, compound that over time, and make money that way? Now, everybody, myself included, goes through this struggle, constantly thinking about what the best way to make money is. Now, for me, even though I love options and I use them on a regular basis in conjunction with the investing I already do, I still want to be able to stick to trying to beat the market, which I think personally is possible by investing in stocks and keeping them for the long term. Now, I did a great video on beating the market, or at least it's one of my favorite videos that I've done. So you can click here to watch that video. Or if you're interested in learning more about options, I have a whole playlist on options as well. Thank you all so much for watching, and we will see you in the next video. Good luck.